Let me tell you about a little trick I like to use to figure out the real price of a stock. Okay, this sounds like a really silly question, right? Because if you go to any financial website, the share prices are clearly listed. Okay, quick question. Out of these three stocks, which one is the most expensive and which one's the cheapest? Well, it turns out that if you just use share price alone, it's really hard to answer this question. We first need to pull in some additional figures. The key ratio that most people like to use is called the PE ratio, and that's computed by dividing the share price by the earnings per share over the last 12 months. So in this example, you'll see that the market is valuing both Apple and Dell at a very similar multiple, but valuing Procter & Gamble at a much higher multiple. Now, I find that the PE ratio by itself is a little confusing and hard to understand. So the trick I like to use is to invert it. So if you take 100% and divide that by the PE ratio, you'll get what's called the earnings over price ratio. It's just 100 over 8.8 in this case. So the earnings over price ratio is a lot more meaningful, I think, because it represents the return that you would have received if you owned the entire company. For example, if you somehow bought all of Dell, your return on the money that you used to buy Dell would have been 10.1%. Now, if you compare this 10.1% to other investment opportunities, such as owning real estate or even a savings bond, it might sound like a pretty good idea to buy Dell. Well, that must have been what Michael Dell must be thinking, because that's exactly what he's trying to do. I hope you'll find this trick useful the next time you have to make an investment decision.